So, good evening, everyone who have joined us for our special project webinar on behalf of PLMD, the developer fundraiser. And the project is for Avery House, which is Blackfen Road in Sidcup. So, delighted once again to be joined by Ajay Kapur, the MD of PLMD Group. Good evening, Ajay.
Evening, David. Thank you for having us here, and thank you for organizing this.
No problem at all. It's always good to have you on. I was just saying there before we went live, we've done so many of these in the last 2 years between project webinars and shareholder updates for other projects. So quite a common occurrence.
Yes, absolutely. It's always a joy to kind of come here on a webinar and show people the fantastic work that the team is doing. Absolutely.
And no doubt you're ably assisted by your team in the background there, I'm assuming, or somewhere hovering around you.
Yes, absolutely. They're all here, and you're welcome to look at them. This is a supporting cast. In fact,
Hi, Lena. Hi, Yaz. Is all right?
yeah, it's good to have a supporting cast just in case things go wrong. And I do less and less, and kudos to the team. They get everything organized, so it's good to have them here if I get stuck.
Absolutely fantastic. So it must be about time I'm due for another lunch, another sort of sushi lunch in your office in Stratford.
Absolutely.
Soon. Okay, listen, let's get into tonight. So can I thank everyone who has joined tonight for this project webinar. Bit of housekeeping. This is designed to be interactive. We do want people to ask any question that you have. So please go into the Q&A. So don't use the chat. If you go into the Q&A, it lets us better manage the questions as they come in. It also means that we can print out the questions and add them to the forum or answer emails as required. So please don't be shy. If you have a question, it not only benefits you, but it benefits the other attendees on the webinar. So it's like sharing knowledge. You might have a question someone else hadn't thought of. Someone else might have a question that you hadn't thought of, but collectively, everyone's getting more information, which is what this webinar is all about, sharing information, getting your questions answered. So stick them into the Q&A, please, and we'll come to those at the end. So if I do the housekeeping, Ajay, please, in terms of compliance. You can just hop on. So it's important before we get into the nuts and bolts about tonight that we highlight that this is a financial promotion. The information that you're about to see has been approved as a financial promotion by our FCA principal. You can see a picture of our website. And if you go to the bottom of our platform stroke website, you'll see a risk warning, which we definitely encourage people to click on and have a read at. And along the bottom there, you'll see that LEOcrowdfunding, we're an equity property crowdfunding platform, and we are an appointed representative of Sharon Limited, which is authorized and regulated by the Financial Conduct Authority. Pitches for investment are not offered to the general public, and investments can only be made by registered investors on our platform on the basis of information provided by LEOcrowdfunding. So that's just setting the scene for tonight. If you have any questions, particularly around compliance regulations, then obviously you can contact the platform. We'll be able to answer any questions on that. So on the next one, so I'm just literally going to hand over now to Ajay. He's going to run through the key aspects of this project. We're actually very excited as a platform to have this project on. It's a little bit unique, and Ajay will explain what I mean by that. But there are multiple potential sources of income in this project. So I'll let Ajay go through it. I'll obviously bounce in from time to time, Ajay, and make some points or ask for clarifications. And then obviously I'll wrap up at the end. And again, any questions, please stick it in the Q&A. So Ajay, great to have you on again, and over to you.
Thank you, David, and thank you to everybody who's joined in. It's always nice to be able to speak to people, and this is a great medium to be able to do this on a Zoom call. So before I get started, we're talking about this beautiful picture that I have on my screen. This is the project we are talking about. It's called Avery House. That's the name of the building. It's 70 Blackfen Road, Sidcup, Kent. That's the address. Sidcup is a well-established place in Kent, not far from Blackwall Tunnel. And this is where this project is. So let me just get into the deeps of who we are first. So we are PLMD Group. We have 90 plus assets built to rent. We've been doing this for more than 10 years. We have 20 million assets under management as a group, which means we manage them, we own them, and we kind of operate them. There's an experienced management team in place. And obviously, we buy into the sustainable, eco-friendly building practices, and we make a big deal out of it. And I'll touch upon this a bit later. So this is about our group. I'm the managing director, CEO of PLMD Group. I've been running this company in various forms for the last 20 years personally, and I'm proud of the achievements that we have as a group. This is the project we're talking about, and this is a development consisting of 7 flats. So this is the current state. It's an income generating product, which means all of these flats are there and generating income. So we got 1, 2, 3 at the back, 4, 5, 6, and 7. So we got 7 flats. They were completed in 2020. There are 2 2-bedroom flats, 5 1-bedroom flats, and 8 car parking spaces, and there's a private garden at the back. We believe we can get planning upliftment for an additional 5 flats on top of this, and we'll spend time on this. But let me just show you what have we done until now. So this is what we bought. So this is a bungalow with a piece of land. This is what we built in 2020, 7 flats, as we discussed, 8 parking spaces. And now we want to do this. In case somebody's wondering, we're building a flat on top of this. As you can see here, we're building 2 flats on the top and 1 flat in the rear. And this is a potential planning upliftment opportunity. Before I go deeper into this, the unique thing that David alluded to earlier about this product is that there are 3 different ways to earn money from this. One is obviously the rental return, because the property is there and it's all built, it's producing rental returns, and we're sharing those rental returns with incoming investors, which is what we have done with our products that we have on Leo in the past as well. So that's for sure, like as sure as it gets. They are rental returns, properties are rented out, we vet the tenants ourselves, so we know who we are letting into the property, and we are sharing a big part of the rental returns from incoming investors. The other thing is, in terms of true ownership, the value of the property would go up for the duration of this investment. And we believe 5 years would be a good time to see what capital appreciation we can get on this. So we're sharing the rental returns, we're sharing the capital upliftment. And to add a cherry on the cake, if I use that term, we're planning for 5 new flats, and we want to share the gains of those 5 new flats with this. So with this background, let me get deeper into this. So this is what we bought. If you see the first picture on the left-hand side, we went through this hard work. We love building buildings, you can see, and then this is what was delivered. Took us 12 to 15 months to deliver this project from ground up development. And this is now an income producing product that we're sharing rental returns for. I won't spend much time on this. I mean, we normally do this for international investors, but we all know London Borough Bexley. It's on the other side of the river, probably the right side of the river, as some people call it. And there's lots of nice places around it. There are pubs around it, shopping parade, churches, etc., schools. Within 26 minutes, you can get to central London. And this is definitely in high demand. I mean, to give an example, I mean, right now the rental market is mad everywhere, but even in this place, my God, every time we get a property which is becoming valuable in 4 weeks, we get hordes of tenants who want to rent a property here. So let's move forward with this.
Hey Jay, can I just jump in there just quickly? So just to clarify, your area of expertise is around London, Greater London. Is that correct? You really focus there? You're not someone that gets sort of shiny objects all over the UK. You're very, very focused on a particular area.
Yes, absolutely. So 2 hours from central London, let's put it like that. And that way, why 2 hours? Because that's what we think we can effectively control very well. We we like to manage it very tightly. So we like to be able to go to the property, touch them, see them, feel them, do things with them, and come back to the office. So something that can easily manage, and I never feel like, oh my God, I'll have to take a flight to go to, I don't know, Manchester or something like that. So 2 hours is where we want to be. So what we're raising here is we're raising 180K. Projected ROI of 5 years is 119%. Internal rate of return is 19%, and I'll touch base a bit more on these numbers, but this is what this would be. The return structure is rental share, capital appreciation, and maturity. Potential planning in 5 years at maturity. So these are the three things. These are the three ways in which the return will be generated. There is a Q&A, and I'm very tempted to answer that, but I'll hold my breath and go through the presentation and then answer that question, because somewhere there, those questions will be answered. So let me get deeper into this. So this is the existing structure has 7 flats, 8 parking spaces, communal garden, and we want to put 5 new flats in there. We have put a pre-app, which is at the submission stages with the council. Let's look at the financials, because that's where the bulk of this happens. So when we bought this property, we bought a bungalow, and we bought for 750K or something like that. We have generated a project value, a GDV of 2.3 million. After renting them out, we have got a mortgage of 1.6 million. And I think this is a beautiful capital stack. It shows 1.625 million. We're raising 180K, and our equity behind this is 504. Let me explain you why I'm spending so much time explaining this, because the big idea is that this is our skin in the game. This is what we're inviting from investors to invest in. What this simply means is, because they are priority shares, you will get the dividend returns first. What it also means is, if the value of the property starts going down or something like that happens, then this is where it starts going down, and we'll have to lose 500,000 before the investors would lose a single pound of their investment. And I think that's very powerful. So I'll repeat that. We'll have to lose 500,000 from here if value starts going down before investors will ever lose any money, like even a single pound. But priority means you'll get the first share on the returns. From a returns perspective, the priority works on the favor of the investors. So just to put things into perspective, we have 70% loan to value currently. After the raise, we'll have 22% equity in this, which is 500,000. We're raising 180K in this. Now let's look at something which is kind of more interesting than this slide, which I thought was a fantastic piece of work. This is the rental distribution. This is one of my favorite slides in this presentation, I would say, because it clearly shows this is the annual rental income from that investment, which is pretty good. The mortgage company would take 88K out of that. We'll spend 7,000 per annum on expenses, management, etc. The return to investors will be 12K out of this, and this will be our remaining income. Now, let me explain to you why this is so good. This is so good because we own 26% of the equity, and this is what our return is. And the investors will have 7 to 8% of equity, and this is what their return is. And that's how a priority return should look like. So you get priority on the return. So this is the funds coming in, mortgage company, management expenses, investor returns, pretty high, our return in line. And the reason we do this is because we want to make sure that investors get the returns first on what is promised. Now let's see how this all stacks up. This is how this stacks up. This is a rental return per annum, and we're giving 45% of rental return per annum to investors. So every year, the rental return will go up. You add these rental returns over a period of 5 years, you see the rental returns you're getting out of this investment. We are predicting a 10% increase in price over the next 5 years. Now, let me say something. Yeah? Obviously, nobody knows how the market would go. possibly nowhere this year, maybe somewhere next year. But over a 5-year period, getting a 10% return on capital appreciation is no big deal. I don't want to say this, but in the last 6 years, it has gone up by 29%. 29% in the last 6 years, but past performance is not an indicator of future performance. We all know that. But we can't ignore the fact that in this area, in the last 5 years, it's gone up by 29%. And I will have a graph, which I will skip to. This is the graph in Appendix 2 of this presentation, where 29% house prices have gone up just for flats and masonates. We're not talking about houses, just comparison like for like. In this area, 29% last 6 years. So for us to assume 10% price increase in the next 5 years is not such a big deal. But yes, I agree, we cannot predict the market. Just depends on how our leaders run the economy. Let's put it like that. Okay, moving.
Can I just jump in there again? Just a very quick comment on that. I think you've explained that very, very well, and you've highlighted the strength, if you like, or the advantage of this type of a structure, AJ. And my personal background started off in buy-to-lets. So you're thinking about buying an individual property, looking after the letting, the management, the repairs, all that goes with that, to then receive a rental yield, which obviously is a very, very challenging way of earning a rental yield. What you're offering is a chance to enjoy the rental yield, to buy income without any of the hassle that goes with buy-to-lets. So if someone came and offered someone the sort of returns that you're offering in terms of your rental share for a property in London, I mean, they think you're mad, but you've structured the deal in such a way that investors can actually earn a really, really attractive return out of the rental without any hassle of management. And I think that's massive when it comes to analyzing this as an investment.
Absolutely, and you hit it on the head. One of the reasons we can do this is because these are new built flats. So they've been built in 2020. They're built by us, so we know what we have built. They actually need a lot less maintenance and expenses like that. But I mean, amazing rental returns are coming from, I would say, on all the properties, but especially these ones which are newly built. People love to live in. I mean, who doesn't want to live in a new flat? Okay, so let me move forward with the other stuff in this. So this is the rental returns. This is the capital appreciation, which accounts for 27% in terms of capital appreciation on equity, 62% on rental returns, planning uplift, and there's a way to capture that, and I'll spend more time explaining how. But we believe the planning uplift is going to give another 31%. In simple terms, if you add these numbers, you get a whooping 119% return on this. But this is only if everything works to plan as per this, which means we get the planning uplift on all the flats, 10% capital appreciation. I mean, rental returns I'm more confident about. Capital appreciation depends on the market, obviously, but 10% is a conservative estimate. 5 flats, if you don't get 5, we'll get 4, 3, something. Some uplift will come. But the potential to deliver this is what's exciting for me personally. Knowing that rental yields are here, that's very good. So you have something that you can bank on as a return, but something to look forward to that this product can deliver. Okay, let's move forward.
Just to clarify that bit from the compliance point of view on the banking, that was obviously a descriptive term. We're not saying that this is the same as having money in the bank. Just to be very clear on that, of course there is the normal capital at risk, and obviously it is a high risk investment. That's the designation within the FCA. So just to highlight that, I know it was just a descriptive term.
No, you're right, and all those warnings are written at the bottom of this. But look, I mean, rental returns, in my view, are probably well managed, and we do get 100% of them. So let's see what happens. There's always this, but this is the rental part, 62%. This is the capital appreciation. This is the planning upliftment, which turns into this. If all the ducks line up as planned, then this is as high as it can get, which in my view is very good. Now let's look at, so rental returns are pretty simple. We can see the rentals will go up every 2 years. We've predicted, so So this year and last year, rental returns were here. Next 2 years, they'll be here. After that, last 2 years, they'll be here. So we have predicted some increase. This is what it is. Let's understand the capital appreciation and planning upliftment now. So capital uplift, which means 10% uplift, which means we will get this much uplift. Uplift in value is this much. You can refinance this. You can pay back the old mortgage. This is the profit, which will be then distributed. 15% of this will be distributed to investors, which actually means investors' principal is this much. Our good profit is this much, which means investor return is actually 27%. And this is a number that I was trying to explain as per this slide, 27% capital appreciation. And I'm happy to take more questions on this later on. But this 27% is explained in these terms. 10% uplift in value, we're sharing 15% of profit with investors, and 27% return is this number. Now let's look at the planning upliftment side of this, which is kind of more interesting. But definitely there's an element of planning, which means we don't know what's going to happen. It seems plausible we could get 5, but I'll be more confident when we get 4, even 3. I think that's a good result. Okay, so planning upliftment, 5 flats, the value is this much, construction will be this. So this is the absolute GDV at the end of the project. This is the construction cost, this is fees, interest, this is total cost. We know this very well because we do this for a living. We build flats, so we know how much these costs would be. When you refinance, this is how much would be gone away, construction loan payment. At the end, the profit that equity participating holders will have will be 368, 250. If you look at the 15% return, which is promised to the investors, that'll be 55K. And 55K on that initial equity represents a 31% investor return. So that 31% investor return is what we are talking about here. So you can see rental returns, capital appreciation, planning uplift. This is what's possible from this product. And this is very exciting for me because I must admit the team that has worked hard in creating the product, I think they've done a fantastic job. I was very happy when the product was presented to me because I thought, wow, this is true investor participation, true ownership, where you get returns from rentals, planning, and capital appreciation. Now, let's look at this in other terms. It's good to look at the same things from different angles. On an average, 12.3% per annum rental returns is being delivered from this. This is based on 45% share of rental income. This is huge compared to the 7-8% equity that equity investors would have. This is a big part of rental income which is being shared. Now, let's look at the capital appreciation, which is 15% of profit share. That is 27% return, and 15% of the planning uplift. And this explained that 119 over 5 years. I'll pause here, so this is very clear. So we're sharing 15% of the profits from capital appreciation, 15% profits from planning upliftment, and 45% of rental income. You add them all up, you get these numbers, you get 119% ROI. Okay, let's move forward. This is just, I think it's a very nice representation. When this was shown to me, I was like, wow, oh, that makes it very clear. So if you invest £10,000 in this, every year you get rental returns. So it's not like you're waiting until the 5th year to get something. Every year you get rental return from your £10,000 investment. At the end, based on 10% return, you'll get 2,700 capital upliftment. You'll get £3,100 worth of planning upliftment. Obviously, you'll get your principal back, which means that 10,000 that's invested, you'll get £21,000 return, 21,974 return. The thing that I liked about this is it shows rental returns are coming every year. Planning application, construction, planning upliftment completed, capital appreciation will be finished at the end of the 5 year. And this is what this product will deliver. Now, one thing that I have not touched upon is the interest rate risk, which is quite a big risk in the current market. This product has got a fixed mortgage. We are in that product for the next 5 years. So the idea is at the end of the 5th year, we can have a liquidity event, get another mortgage, and that would be one of the ways we would exit from this. And that leads me nicely to the revaluation, further borrowing, revaluation after building the 5 flats, additional finance on the group portfolio. So one of these exits will be triggered. My understanding is that revaluation, further borrowing on the same project would deliver the exit that we need from this. David, this is probably more for you.
It is indeed. I wonder should we do the questions first?
Fine.
I think yeah. Let's do the questions, and I can wrap up this bit. So there's some really good questions have come in. So someone's asked, will the slides be available? Yes, we will get those slides sent out as we normally do, either tonight or tomorrow morning, to all the attendees. That's fine there. We obviously don't read out people's names because this is obviously live, and then it's going to be recorded. So we don't read out a name. So I hope no one's offended by that, but just protects anonymity. So Ajay, what is the plan to take a decision if the market value of the property is lower in 5 years than it is now? So what would the plan be in that situation? So it actually ties in with another question down here. We're currently seeing capital depreciation in the residential market. Is a 27% forecast capital uplift realistic or too optimistic? And then what happens if the capital losses? How would that affect the investors? So yeah, basically two of the same questions.
Yeah, absolutely. So I'll be very surprised if in 5 years' time the market has not started going up, but that's fine. Let's work on the assumption that property market is actually not going up, not going down, it stays where they are. So we have already got our rental returns. That's coming anyway. So yeah, so with this kind of product, you always have like a floor, if I use that term. So you will definitely get your rental returns. Even if there is no capital upliftment, we believe there'll be an upliftment on the planning side, and that would deliver some returns in terms of the fact that we can get planning upliftment. That should cover or mitigate some of the losses. Yeah.
Mm-hmm.
Let me just stop sharing my screen for a second.
Yeah, I was going to actually say, sorry,
Yeah.
I was going to actually say, bring up the slide that you showed with all three on the graph.
Yeah.
And I'll make a comment that might help that. It's just what you said, but taking it slightly stage further. That one there. Yeah, perfect. So just as Ajay said, just taking that slightly further, the way I looked at this when we discussed structuring this, and Ajay's alluded to it, but I think it's really is important to highlight it. There are definitely elements of this that only time will tell. So planning uplift, capital appreciation, that is, there's outside factors that may affect that outside Ajay's control. The rent he's certainly got more control over because obviously he manages the properties. But the way I liken it is this: so the rental income, that 45% that's on the screen there of the net rent, that's the cake. So that's the main thing you're going to eat for dessert is the cake, and that's, if you like, the fundamental. Now, if there's some capital appreciation, and it does turn out to be some, that's like the icing on the cake. But if the icing doesn't come, you still have the cake. And then if the planning uplift delivers, that's like the cherry on the icing on the cake. So it's like fundamentally there's a cake, capital appreciation, planning uplift is like bonuses. And if they come, then you've got a very nice dessert. So that's the way I look at it. Hopefully that's helped. But that's, I think, a good way of putting it.
That's definitely got me hungry, David, but I get it.
On me. Okay, another question here. I note that there is an assumed refinancing at maturity, and you've shown interest rates as a potential investment risk in the investment document. If mortgage interest rates are higher in 5 years' time and eat into or eliminate the rental profits, would that change that plan? If so, what would be the alternative plan?
Yeah, let me try and answer that. And thank you. That's a good question. I like these kind of questions because then you can show the strength of the product. So this product finishes when the current mortgage deal finishes. The current mortgage deal is on a fixed rate of interest. So any changes in the interest rates between now and the next 5 years should not affect us. So this is insulated from any raises in interest rates. When we secure a new mortgage, that would be on a new product at a new rate in 5 years' time. And I don't want to predict where that would be. But by that time, because the new mortgage has come in, we would have done refinancing, we'll be able to pay back the investors on this one. Now, let me just touch base on one other thing. Yeah, somebody said earlier, what if the property prices start going down? Look, we all are property investors. If property prices go down, then you need other things to prop up the risk in the market, because we can't change that, what the property prices are. But what we can do is we can prop up the returns from rentals and for planning gain. And that's what this product provides. So even if this doesn't work out as planned, the other two would work out, hopefully. And if this planning gain works out 50%, the uplift in capital appreciation 50%, you have more than one avenues to make a return from this product. This is not one of those products where we're going to try one thing and see what happens.
Yeah.
Here we have this thing which we all know is good. This thing we believe will be good by the time. This thing, yeah. So there's more than one avenues to make money out of this.
Yeah.
What is the distribution? Okay, David, you want to read out the next question?
Yeah. So what is the distribution schedule for the rental income?
Yeah, and this is the perfect slide for that. So we get 123K rental income. Out of that, 88K goes into mortgage, 7,000 management expenses, 12,000 return to investors, 15,000 is our income. And this is very good because if you think about it, we have an equity of 504K. We're raising 180K, but the rental return that we're offering is much higher, much better.
Mm-hmm. Yep, no, that's good. Okay, I'll invite further questions before we wrap up in a few minutes. But if you want to go on to my wrap-up slides then regarding the platform, AJ, if that's okay.
Yep.
And again, invite any other questions that anybody has. They always get it in now, and we can do one quick fire round questions at the end. So just to highlight the next steps. Tonight has been recorded, and these slides will be sent out to everyone who is on the webinar. So you get a chance to replay it again, listen to information again. But what's really important is that before you make an investment decision is that you go to the platform. You can see on the left-hand side is what we call the pitch pages. That will be on our homepage. And you can see there when you click on that thumbnail, you'll have overview, you'll have financials, and you'll have team. And you'll also have a forum. So you can post questions in the forum, see what other people have asked, see the answers. Great way to educate yourself. But you'll be able to access what we call the brief information via this pitch page. Then to the right of that, where the arrow is pointing to, there is an equity offer document. This is the investment memorandum. And on the right-hand side is a picture of the front of that. And this is the document that you should base your investment decision on. This has been approved as a financial promotion. The information in here has been checked for material statements to verify claims can be backed up. And it lays out more detail than we're able to go into tonight. There's annexes there, more information about the location, the financials, AJ and his team, which is very important. There's a very good picture in there of his AJ's wider team. You've met Lena and Yaz earlier on the webinar, but there's a wider team behind it. So it's all there in the offer document. Next one. So then from tonight, the important thing is that if you feel this is an investment that you would like to participate in potentially, then what you can do is on that homepage, when you click on the thumbnail, you'll see what we call a register your interest box. And you can leave an email address and an amount that you may be interested in investing once you've finished your due diligence and have all your questions answered. And that just lets us confirm your interest. Now, this is not making an investment. When it opens live for investment, you still need to go in and actually make your pledge. But this does let you register your interest, and therefore the team can stay in touch with you, make sure you get your questions answered, make sure if there's anything changes in the project, then you can be informed of that. So it's just really you indicating that you want more information on this project. So I really encourage anyone on the webinar tonight, if you're thinking this may be something you're interested in, then please do leave an email address and an amount that you may be interested in investing, and we can log that against the project, which is very helpful. Okay, I think there's a few more questions firing in there, AJ. So let's run through a couple extra questions. Do a time check. Yeah, so we'll finish in about 5 minutes time. So just to clarify, how often will the rental income be distributed? Is it quarterly or annually? So
yeah, so rental income is distributed yearly.
Yeah, it's just done annually. Okay. When will the annual rental income be paid out? Will it be quarterly or yearly? Same thing. So that's done. How often will rental returns be paid out to investors? Okay, again, that's going to be rentals annually. I may have deleted a question there by mistake. I don't think so. So just with 3 questions, all very similar, which is fine. And then further to my second question, I note that there is a mortgage facility of 1.6 million, and the first year's interest payments total 88,000. That equates to an interest rate of 5.5%. The rental income is currently 123,000 on a property value of 1.6 million, which equates to a rental yield of 5.2%. So for every 1,000 of mortgage property, there's actually a small 0.3% or £3 net rental loss even before PLMD Group's management costs. If the interest rate increases to say 7% in 5 years' time, then the loss will increase to 1.7%. So there may be a misunderstanding of those figures. I'll let you, AJ, answer that question or clarify that. No, the property value, the property value is 2.3 million.
Yep. So let me try and answer this. Yeah. So the property value, according to Rick's valuation, November 2022, was 2.36 million. If you think about it, the mortgage is 1.6255 We're just raising 180K. Behind this, we have a 500,000 of group equity. And this product is only for 5 years. So this question that what happens after 5 years' time, investors will be paid. The question is, how much return will you be able to pay them? And this is where this comes in. We are hoping to pay this. Let's see how the market plays out. And we are pretty confident about the rental returns. Then there is capital appreciation. That's dependent on the market. Planning upliftment, which we believe we have a good scope of. So from my perspective, we can't change the interest rates. We don't have any control. The only thing we have a control is that the rate is fixed for the next 5 years. So irrespective of what happens in the market, the rate will be the same for us. The market can go here or there. But for our investment, for the duration of this investment, the rate is fixed. What I am excited about this is not like the small loss in rounding figures, etc. that was in the question. What I'm excited about is the fact that the gray side shows what we have built. The pink side shows the potential of what we can build. So even though capital appreciation may or may not happen, rental returns are assured from this one, as assured as they get in rental market. But look at the upside that this brings. 2 units to the second floor, 2 units to the mansard roof, 1 new detached rear unit. What this means is that if we get these 5 extra flats, we're actually sharing the profits of this with the investors. So the rounding errors that were there in the question is not something that I want to bog down myself with. I want to look up to delivering the positive returns that we can deliver from a planning upliftment.
Okay, so if that answers the question, or if there's a follow-up question, we'll allow a little bit of time for that. Maybe I'll just finish on highlighting the priority share status. I know you've alluded to that, but investors in the SPV through the Leo crowdfunding platform, you're buying a share in the SPV, you become a passive shareholder, and as Ajay's already alluded to, it's a priority share, which means that you are paid out your projected your target return on investment before Ajay and the team can access any of the profit. So that buffer, if you like, if things don't go as well as planned and the rental income is less, then it eats into PLMD's part of the profit before it affects any of the shareholders. So that's as Ajay's got on the screen there. There has to be in this case, a 15,000 drop in income before it affects any of the crowd investors. That's one of the beauties of the way this is structured. So there isn't any security. There's no PGs or debentures or charges over the property. This is equity, but it's priority equity. And really what investors need to ask themselves is, what is the likelihood of things going so wrong that 15,000, which represents a fair chunk of the overall income, actually happening. And therefore, as Ajay said, we're doing the rental market in a high demand rental area, in a high demand rental sort of sector as it is at the minute. Then there needs to be a lot of problems on the rental side before it eats into that level of income. But again, it was coming full circle. There's risk warnings in the documents for a reason, and therefore you need to be aware of the risk as well as the reward of this investment. So I think if we just go back to the one slide before the end, Ajay, we can wrap up just to remind people about how they can register your interest. So say go to the homepage, download the equity offer document, and then if you do have an interest in this project, then please, even after this webinar, jump on, just take 2 minutes, record your interest, and then we'll know just to stay in touch with you and make sure you have all the updates. So any last sentences, Ajay, before we wrap up?
All I would say is I'm very excited to have this product on board, and I wanted to thank you, the team who has delivered this product. And on top of that, rentals have gone up by almost 15% on this property in the last year or so. That's how good the rental returns are right now. And I'm not saying only on this property. This is happening across the London, but this one has definitely delivered those results because these are new, beautiful flats. Thank you, David. Thank you, everybody.
Okay. And what we haven't done is give a go live date. So we are targeting a date next week to be live for investment. But again, if you leave your email address and your registered interest, then we'll make sure you're the first to know about it when it goes live. And then obviously we'll be making that known to the rest of the database. So you can keep an eye out for that. But it is, Ajay, we're targeting a go live date of next week. So last quick question: is registering an interest a commitment to make an investment? Should I read the full investment document for you? Okay, really good question. So let me again be really clear on this. So thank you for highlighting that. First of all, yes, 100%, absolutely. Always read the full investment document before making a full investment. But this recording of the interest is not a commitment. Okay, so this box on the screen, this is not a commitment you're tied into. It's effectively, if you want to call it, reserving your seat or registering your interest. But before you actually have to commit, there will of course be a live pledge and a shareholder agreement that you'd have to read and accept, and only then are you making a firm commitment. So hopefully that clarifies that. This is recording your interest is not a full commitment, but we encourage people to do that if they do have an interest. So they've effectively logged that, and we can communicate with you in a more informed way. So thank you for that question. I really appreciate that. Okay, well, listen, thank you everyone for being here tonight. Again, brilliant. Ajay, really good and thorough presentation, well explained. So thank you for that. Very, very clear. I think that's one. I think a lot of our investors enjoy your presentations because you're very much to the point, detail, able to answer questions. And this project is a little bit different because of the 3 levels of income, but you have explained that very well tonight. So thank you for that. And everyone knows they can get in touch with Leo Crowdfunding with any questions you have to follow up. So thanks everyone. Take care. Stay safe. Until next time. Bye-bye.
Bye-bye.